two, 1, 2, 2, 2, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. One, 2, 3, 4, 5, 6, 7, 8, 9, 10. 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31, 32, 33, 34, 35, 36, 37, 38. Yep. Check, check. 1, 2, 3, 4, 5, 6. Stop. Okay.
Is that? They said when it's off. Yeah, that's fine. Assalamu alaikum, everybody. Can everyone take a seat, please? Assalamu alaikum and good morning, everybody. How's everyone? Had a good breakfast? MashaAllah. No, I'd like to just firstly, all I'm going to do is really introduce today's session. For those of you who were there yesterday, alhamdulillah, we had a very good day. I thought the presentations and the contributions were very good. My name is Faisal Karbani. I'm the founder and CEO of a company called Simply Ethical here in the UK. We've been going since about 2010. I've actually been working in the Islamic finance industry since about 2005 in the UK. I trained as an accountant and then worked for a number of years in accounting and commercial finance and then moved into Islamic finance in 2005. Alhamdulillah, when Al Baraka were organizing this conference and they had the title of the Islamic economy in the UK, I was very much attracted to come to this event and to be part of it because this has been my passion for the last 20 odd years to try to get and play a part in the Islamic economy, the Islamic finance industry in the UK. And alhamdulillah, it's been a good journey. It's been challenging. We are only a very niche player in this, sort of predominantly conventional-led finance, in the UK. But UK being a hub of finance and a center for global finance, it's been a great kind of place to be in that sense. And in Europe and in the Western world, UK is, alhamdulillah, the leader, I think, in Islamic finance. So there's so much more to do. But it's conferences like this which I think really help because it brings people together. We get to talk, we get to exchange ideas. It adds momentum to the industry. So I'm really grateful to Al Baraka for making the investment into an event like this. So really, today my job is just to really introduce today's session, which is centered around Takaful. And we're very blessed and I think lucky to have two very good people from the IFSB with us. For those of you who know the IFSB or may not know them, they're based in Malaysia. They're a standard-setting body that do a lot of great work. They've been going also for about 20 years in the industry, and they have a number of members. They have 187 members, comprising 80 regulatory authorities, 10 international intergovernmental organizations, and 97 market players, financial institutions, professionals, firms, industry associations, and stock exchanges operating in 57 jurisdictions. So they're truly global in nature. They perform a very, very important role so that you have the conventional kind of architecture and infrastructure when it comes to conventional finance. Islamic finance as a kind of, I suppose, something that's been in the modern era around for the last 50 odd years has had to come up with its own infrastructure around the industry. The IFSB complements that of the Basel Committee on Banking Supervision. So they kind of complement the work in the conventional sector, but they have a focus and nuance towards obviously the Islamic sector and the standards and the regulations needed there. Because when you have a new industry, there's a lot of growing pains, there's a lot of standardization that needs to be put into place so that the industry can flourish in a framework which, hopefully has high standards, but also uniformity in terms of what consumers are getting and the standards they have to adhere to. So basically, the two speakers today. First, we are very lucky to have the Secretary General of the IFSB, Dr. Bello Danbata. Dr. Bello, it was a pleasure to meet you this morning only. I've not had the pleasure before, but mashallah, he's got a very distinguished, mashallah, CV. Previously, he spent has over 29 years of combined experience in the private academia as well as the financial services regulation and supervision sectors across Africa, Europe, Asia, and the Middle East. So he's, I think, the right man to lead the IFSB, being such an international organization. It has a very distinguished CV, as I said, mashallah. You know, a member of the IOFI, work on that's obviously very, very important, and sits alongside the IFSB in the work they do. So without further ado, Dr. Van Bata, why don't you come on and your presentation?
Thank you so much. All right, Bismillahir Rahmanir Rahim, wa sallallahu ala sayyidina Rasul. Very good morning to all of you. It is indeed, once again, an honor to be here with you and for us to have this joint workshop with Al Baraka. We believe our mandate, as highlighted by the welcome remarks by the brother, is that we are to promote the stability and resilience of the global Islamic financial services industry through the development of quality industry research as well as development of prudential standards that will help the Islamic financial service industry maintain its stability and resilience. And as he rightly mentioned, we'll complement the work of Basel Committee on Banking Supervision, we'll complement the work of ISCO, and we'll complement the work of International Association of Insurance Providers, IIS, as well. This is in addition to recent mandate that we included we covered the work of ID as well, International Association of Deposit Insurance. So our work is to cover all the three sectors, unlike ISCO that is focused on the capital market, and BCBS that is focusing on banking, or IIS that is focusing on Takaful alone. We develop these prudential standards and we support the implementation of this prudential standard. And as highlighted by him, we have just recently additional member actually, which is the Bank of Russia. So Bank of Russia joined the IFSB membership, which makes IFSB to now have 188 members from 58 countries. These 188 members, as I mentioned also yesterday, comprises of 81 regulatory and supervisory authorities, mainly central banks and capital market authorities. And we also have in the IFSB membership 10 multilateral international organizations, that is the IMF, the World Bank, the Islamic Development Bank, the Asian Development Bank, the United Nations Development Program. They are all members of the IFSB, in addition to the market players, 97 market players that we have. The work of the IFSB has been tailored towards complementing these specificities for this Islamic financial services industry. So we are very, very grateful, and I'm so much delighted for IFSB to collaborate with Al Baraka in having this workshop, and I confirm to Al Baraka our commitment to support all these kind of initiatives. IFSB as an NGO, we actually don't charge for our standards. All our standards are free, and they are translated not only in Arabic, but as well IFSB standards are available in French as well as in Russian languages. And this is a project that is being supported by the ISDB. Now, guided by the IFSB core values, which is basically accountability, integrity, collaboration, and responsiveness to the global Islamic financial service industry since our establishment 20 years ago, as he highlighted. The IFSB's mandate is to ensure that there is consistency and there is no room left that is not closed in terms of disadvantage exposure to the Islamic financial service industry. And we have seen through our work recently, despite the pandemic, the Islamic financial service industry still maintained its resilience compared to even the conventional financial service industry for a certain number of reasons. So, as you are also aware that the global Islamic financial service industry, as I mentioned yesterday, based on our IFSB Stability Report 2022, is now, the total assets is now standing at $3.25 trillion US. We hope this figure is going to continue and to reach 4 trillion, as soon as possible. And we believe this kind of initiative of having Al Baraka Summit and initiative will ginger the industry and will create more opportunity for growth for the Islamic financial service industry. Definitely, the Takaful segment has been seeing a remarkable growth over the years, but is compared to the other sectors, banking and ICM, is still a very small portion of the global total asset for the Islamic financial service industry. So we believe that a lot needs to be done, and how Takaful is perceived by the general public is something that maybe there is misconception that maybe Islam, the assumption that Islam prohibits taking protection for anything, because the understanding is that you have to believe in Qadar. It's one of the pillars of faith. So when you believe in Qadar, doesn't mean that you should not mitigate against any potential risk that may be arising. So this need to be promoted, and we believe that with the new digital transformation and accelerated digital transformation, the Takaful industry will take advantage of fintech platforms and other digital initiatives. So the Takaful sector, we definitely believe that it is also not immune to any financial instability like the insurance. So continuous commitment, capacity building, and sensitization, as well as development of robust regulatory framework is quite essential. In today's workshop, we will focus on few IFSB standards, and I'm very happy to have one of our senior consultants at the IFSB, which is Mr. Peter Casey. Mr. Peter Casey, as you all know him, he's well-known in the global financial services industry, and he has held several positions, similar positions that I'm currently holding now. And he is someone that I personally give him a title of Royal Consultant of the IFSB, because he is the only consultant among the consultants that has worked in the IFSB for all the three sectors. Peter Casey has worked on Takaful standards, he has worked on ICM standard, and he has worked on banking standard. But of course, in this room, Peter is not the only IFSB consultant, because I have Prof. Habib as well sitting down there. But Peter, being a most senior consultant and who has a robust experience in prudential regulation, we choose him to be, who is also resident of the UK, we choose him to be able to facilitate this particular workshop, because we believe what we are talking here is Takaful in the United Kingdom, and maybe some aspect of globally. So in today's workshop, I will be able to support Peter Casey on the fundamental questions and strategic questions related to the work of the IFSB, and of course fundamental questions related to the conceptual framework of Takaful in general. Being an academician before, so I will always be very happy to answer some questions. But I want to make it as a disclaimer, definitely, that the IFSB having this big number of institutions, and we as regulators that work closely with regulatory and supervisory authorities, we try as much as we can to abstain from criticizing any particular jurisdiction. So please, if Mr. Peter dodged any of your questions, is because of I gave him the instruction to do that. He has the information to share with all, but we try as much as we can. We don't criticize any particular jurisdiction, but we can criticize the practice. You have questions on the practice, you have issues related to that, raise it up. We want to make it a more engaging kind of discussion today, and we want everybody to be free and to understand more about Takaful and to promote more Takaful practices, and the resilience of Takaful industry, we believe, is very, very essential. Especially now, finally, as we are having these challenges with climate change, we believe Takaful can play a greater role in climate-related financial risks, particularly in disaster recovery and focus-based financing using Takaful. So we believe Takaful have an opportunity to contribute to the global Islamic financial services industry. And lastly, as well, Takaful, we believe, can be promoted through a number of hybrid products. We want to see the Sukuk issuances and any maybe fintech applications is also having some element of insurance or element of Takaful for whatever asset exposure that may be arising, because we believe the fintech companies as well as other initiatives, innovations in the financial service industry the service providers try as much as they can to refrain from talking about the potential risks that may be arising. So we want to push the regulators to make sure that these service providers bring out the reality of the potential risks that may be arising, and then we recommend that Takaful should be the instrument to be able to supplement and protect the consumers who are going to be exposed to some of these risks. So I definitely, once again, be very happy with the organizers, and I thank Al Baraka group for this coordination. And I, as I mentioned to my colleagues in Al Baraka, that we look forward to have more of this event, even in the Latin America region, in the Spanish regions, and also in the Russian regions as well as French. We have quite a number of French. Brother Jaffer is signaling me on French, but I think we have already have all the IFSB standard translated into French, and we have conducted a number of workshops in French because in the IFSB Secretariat, we have people from across 18 countries. So we have French-speaking, Russian-speaking, Turkish-speaking, all among the IFSB members. So on that note, I look forward to a productive and enlightening discussions throughout today's workshop. And please feel free to contact us anytime and anywhere if you need any clarifications or you want to engage with the IFSB. Our mandate is to promote and support capacity building globally without charging any fee. So thank you very much. Assalamu alaikum. Thank you. No, I sit here.
My thanks to Dr. Bello for that introduction. I'm Peter Casey. There are many things that I am not. I am not an accountant. I am not a lawyer. I am most certainly not a Sharia scholar. What I have been by profession is a financial services regulator, and it's in that capacity that I try to address the issues around Takaful. I'm conscious that there are some people in this room who are very thorough Takaful professionals, who almost certainly know more about it than I do. However, I'm conscious also that there are some people for whom Takaful is on the margins of their interests in Islamic finance. So I hope you'll forgive me if I start by talking a little bit about Takaful in general, why it's an issue, and what issues it poses then to regulators. Roughly speaking, up to the coffee break, I shall try and deal with the more general issues. After coffee, I shall come back down to the regulatory and supervisory issues in some detail. Dr. Bello has advised me to dodge some questions. I think he underestimates the amount of time I've spent in the British public service, where that is one of our greatest skills. So I hope to be able to practice it where necessary. Okay, here, yes, is the structure of the presentation. And I start fundamentally with the issue of why Takaful? Why are we talking about any kind of special structure? What, therefore, is wrong with conventional insurance from an Islamic point of view? And there are really three big issues here. Yes, there are some other things, for example, your ability to trade in currencies, which will affect the details of practice and of regulation. But there are really three big things in ascending order of difficulty. What can you cover? Where can you invest? And fundamental uncertainty. By the way, I should say that because this is a multinational forum but is based in the UK, I will tend to use a lot of normal insurance terminology. Sometimes the scholars will say, well, it would be better if you use slightly different terminology to emphasize some differences. But I'm hoping to give those who are UK-based or who are used to conventional insurance points of comparison. So the first issue is, what can you cover? Well, that's really rather straightforward. If you're an Islamic insurer, you clearly cannot cover the so-called sin industries. Yeah. You are not going to provide cover for a brewery or a lap dancing club, or indeed a conventional bank. Straightforward enough. There are some more technical issues on which not all scholars will agree, and these include things like life cover relating to unborn children, what happens if somebody causes damage while drunk, which they shouldn't have been in the first place. But those are essentially technical. And if those things were all, it would not be too hard for people to work out an insurer that would function well. The slightly trickier issue, technically you can get the answers quickly, but they give you problems in running your insurer, is where can you invest? Now, if you're doing general insurance, classically general insurers put a lot of their money into bonds, low risk, steady return, and available where necessary in relatively long durations. Clearly, if you believe that interest is wrong, you're not going to put your money into bonds. What alternatives do you have? Well, the most obvious is going to be Sukuk, but they may or may not be available in your jurisdiction in suitable amounts, durations, and so on. Yes, you may buy on the international market, but that creates other difficulties, because your use of derivatives for risk management is also heavily curtailed by Sharia. So if you've got a currency mismatch, say between the Sukuk you want to buy in the US dollars and the businesses that you are covering in British pounds, you are not going to be able to manage that mismatch away through currency derivatives. So there are some issues, they're technical, they make your life hard. If you're doing long-term life, family takaful, use whichever term you want, but with a significant investment component, then typically your conventional counterparts will be putting a lot of their policyholders' money into equities, either directly or through funds. Clearly, those equities will also need to pass Sharia screening in the same way that an Islamic fund does. And yes, you will not be buying shares in conventional banks, in breweries. You will have one or two tricky issues around things like the commercial property market. But those, again, are reasonably well known. I should also add that in some parts of the investment area, the principle of necessity may sometimes be invoked. And I can think of one Middle Eastern country where the legislation on insurance said that insurers must hold X% of their money in government bonds. The government wasn't issuing Sukuk, so the only bonds available were conventional ones. And the scholars in that country said, yes, a takaful operator there may, under the principle of necessity, obey the law of the land and may invest in the government bonds. So sometimes that principle may be invoked and will get you out of difficulties, but only, I suggest, if those difficulties are really quite severe, like local legislation. Now, if those two things were the only problems, yes, there'd be some difficulties, but they wouldn't be fundamental or structural. And indeed, here we hit an area where the Sharia scholars do diverge. And scholars in Iran, after the revolution there, took the view that those were indeed the only fundamental difficulties with conventional insurance, and that a conventional insurance structure with Sharia-compliant investments and Sharia-compliant coverages was permissible. More recently, scholars in Turkey have taken a similar position after some years in which their positions were rather different. And so in those countries, you might expect to see something that structurally looks very like conventional insurance. However, those scholars appear to be in a minority internationally, and the main problem that the majority of scholars have is that they consider that insurance contracts are characterized by fundamental uncertainty, our old friend Harar. And let's be clear, the scholars believe that that fundamental uncertainty is inherent to the insurance contract. There is not a way you can structure it away and say there is no Harar there. My understanding of their position, and remember I'm not a scholar, is that rather they conclude that Harar is forgivable under certain circumstances. And those are generally, well, for insurance, if the structure is based on principles of mutual assistance, mutual guarantee, and the premiums in conventional terms are considered as donations, tabaru, for that purpose, mutual assistance, then the Harar is forgivable. And it is this principle of mutual assistance and mutuality that really drives the different structures that we've come to know as Takaful. I should add that sometimes in a discussion, somebody will raise the prohibition on gambling, mezir. My understanding is that, at any rate, the large majority of scholars do not consider that to be a problem. When I have read a couple of the key scholarly opinions in translation, this has not been invoked. And my understanding also is that if it were present, it would be an objection to essentially any insurance structure. So that is not something that you can forgive by adopting a somewhat different structure. So although this sometimes appears, my understanding is that the large majority of scholars would regard it as not relevant. I mentioned key Sharia rulings. I guess the big two that I would look at if I were looking for rulings on Islamic insurance would be the IOFI Sharia Standard number 26 of 2005, and a rather lengthy resolution from the OIC Fiqh Academy. Its number is 200 and its date is 2013. Both of those are available in English. So they are the key two, but let us not forget that there are some scholarly divergences, and I've already mentioned them. So you would not necessarily say all scholars accept these rulings. Okay, so what are we talking about then? Well, what does Islamic insurance look like? Well, the rulings that I have cited certainly imply there must be at least a significant degree of mutuality in there and a principle of contribution by donation to that end. Now, so why do we not see huge numbers of purely mutual insurers around Islamic finance? Yes, a mutual structure will indeed work. no question that you can have a mutual insurer that meets all the required principles for Takaful. The trouble is that mutual insurers are extremely difficult to set up these days. Nasty people like me, insurance regulators, tend to require that there be some capital in the company from the outset, and that is very difficult to build up on a mutual basis. Occasionally, someone around this industry will say, can you not have what is known in the trade as a calling mutual? That is, a mutual that can ask for additional contributions from its members. Well, we know those structures from conventional insurance. They do exist. They've been relatively common in an area of the shipping industry, in the so-called protection and indemnity clubs. And yes, that makes your life easier. But I have to say that, again, most regulators do not regard that as a plausible way of meeting the need. Protection and indemnity clubs usually have sort of a dozen huge members, big ship owners. Could you really do a retail Takaful company on the basis that if we have a bad year for motor insurance, we're going to ask everybody to stump up some additional contribution? Would you get the money if you tried? Regulators, who are generally quite cynical people, won't believe that. So, although that solution is sometimes invoked, most people would say it's not a practical solution to a real problem. So, unfortunately, perhaps, the pure mutuals will have, at any rate, a very limited place in Takaful. Yes, they might work as a club of people who know each other well. If you're talking about crop insurance in a handful of villages, or other micro Takaful, a pure mutual might work. But it is very hard to get there from here. So, what do we see practically in the Takaful market these days? Well, the most common model essentially involves a policyholders or participants risk fund embedded within a company which also has shareholders and which also has funds which are deemed to belong to those shareholders. If you're doing family Takaful, there may also be a policyholder's investment fund, and that will generally be separate from the risk fund. Come back to that later. The exact relationships between shareholders and policyholders' funds do vary. There are some structural differences dependent on the Islamic contracts they're based on. And again, I will come back to that later. Saudi Arabia has a unique model, which it calls the cooperative model. It was clear to me reading the Fiqh Academy ruling, at any rate, that that academy was broadly content with the Saudi model. But it is one that has not been followed more widely. And because it's unique to one country, I'm not going to talk about it in more detail. What I am going to talk about, for the benefit of people who are not totally steeped in Takaful, is a market. I will deal with it, a model I will deal with first for general insurance. It's the so-called hybrid model because it is based on two Islamic contracts, Wakala and Mudaraba. And this is probably the one that has the widest degree of Sharia acceptance. Even where other models are common in a particular country, you will not tend to find their scholars saying, no, that model is absolutely wrong. They may say, we have another model that works and we're going to do that, but they won't say, this one is not permissible. And within that structure, you typically have some funds that belong to the shareholders. Call them the shareholders fund. You have a policyholders risk fund, and you have policyholders. Surprise, surprise. The policyholders pay their contributions. Most of these go into the policyholders risk fund, and a certain proportion of them, however, it normally is a percentage of the contribution, under a wakala agency contract, go into the shareholders fund. And that's what fundamentally remunerates the management for their work in running the company. Come back to the detail of that later. From the policyholders risk fund, claims are paid. And also certain other expenses, particularly claims handling expenses, may be taken. Of course, there are some other expenses. There are operating expenses. Somebody is paying the rent on the buildings. Somebody has bought all the computers. Somebody probably pays for the advertising. Those things are paid for out of the shareholders fund, and it's the wakala share that primarily fuels that fund, at least in a general insurer. Of course, you will probably need reinsurance, or in this case, ideally, Takaful. Takaful premiums will be paid out of the policyholders risk fund, and Takaful recoveries will go into the policyholders risk fund. Or at least they jolly well should do. I'll come back to some regulatory issues around that later. Okay, that's all fairly straightforward. Now, the policyholders risk fund, in some instances, the shareholders fund may be entitled to a so-called wakala success fee if it makes a good job of the underwriting. This gets a little bit controversial from time to time, and some of the scholars tend to hold their noses a little when you mention these things. And I will explain to some extent why that is an issue later. But it is, in fact, a relatively common practice. Now, the policyholders risk fund, you hope, has built up some money. And typically, insurers of all kinds hold money, because after all, even in a conventional insurer, you pay your premiums before any claims are made. So there's money to invest. And with any luck, there are some investment profits that go into the policyholders risk fund. And again, the shareholders fund in this model is entitled to a mudarib share for its role in managing those investments. A share, of course, of the profits. That's incidentally why we call it the hybrid model, because we've got wakala and mudaraba going on. Now life gets interesting. Over time, the policyholders risk fund may have some surplus. I'll talk a bit later about some of the issues that raises. But that surplus belongs to the policyholders. It's the policyholders risk fund, not the shareholders risk fund. So in common practice, policyholders risk funds will or may distribute part of the surplus to the policyholders, and exactly how, exactly when, on exactly what basis we can talk about later. And I know that there's at least one person in the room who has told me he'd like to talk about that later, so we shall. But not for the moment. I'm still slogging my way through the model. Now, of course, the policyholders risk fund may be doing wonderfully. It may not. It may have had a dreadful time. And in that case, the policyholders risk fund may indeed be very thoroughly in the hole. And what normally happens here? Well, What will normally happen is that the shareholders fund will contribute to it in some way. After all, it's exactly because regulators are nervous whether the policyholders risk fund can stand on its own that we have this model of a fund embedded within a shareholder company. The normal way that it will do this, clearly it can give money, but it will be to contribute an interest-free loan card. That may or may not be a regulatory requirement, but it is common practice. It raises various questions when you come to think about capital adequacy, but it's the common practice in the industry. Okay, so within general Takaful, you can, now I have shown a very common model. There are others. You can use different Islamic contracts. For example, Waqf is used as the basis for the policyholders risk fund, particularly in Pakistan. And that, as I understand it, is because the Sharia tradition there, which I think is the Hanafi tradition, has a view that that a Waqf can be conditional, and the conditionality is something that you need to make this structure work. But if you want to get deeper into this, please find a good Sharia scholar. So that is a structure that will work within the Sharia tradition of Pakistan. It would not necessarily work in, say, one of the Gulf countries. There are, I should also say, some questions, and I've already flagged it, around the use of conventional reinsurance. I will definitely return to these from a regulatory point of view. I think essentially everybody accepts that the ideal is to use Takaful, and I'll talk a little bit about Takaful later, but principles of necessity are often invoked to use conventional reinsurance. And there are many questions around CARD, not of course about its permissibility, but about its consequences and what fundamentally it says about the structures of Takaful. Again, come back to some of those later. Now, if we were doing family Takaful, life Takaful, there would, as I've already said, normally be one or more policyholders' investment funds, which are again considered to belong to the policyholders. They are not supposed to be risk-bearing, save for the investment risk, and those are the savings contributions. In practice, I see two distinct ways those are modelled. In some cases, the contributions are split from day one. Part of them go into a policyholder's risk fund, effectively to pay for the life cover. Part of them go into a policyholder's investment fund. The alternative is that the entire contribution, net of the Wakala share, of course, goes into the policyholder's investment fund, which then drip feeds into the policyholder's risk fund, effectively to fund the life cover every year. There's a big policyholder's investment fund, you hope, and with any luck, it's making profits. And the Takaful shareholders will therefore, as before, be entitled to a Mudarib share of profits that are being made. And those firms may effectively be dominantly asset management firms in some cases, and that may be their biggest share of shareholders' income. And, of course, the investment risk from the PIF is going to be passed to the policyholders. You know, the classic British with-profit structure really does not work because it involves degrees of guarantee of earnings. So the investment risk goes through. It looks very like, in those terms, what conventional insurer would recognize as a unit-linked structure. Okay, so that's what Takaful looks like. What does the Takaful market look like? Well, probably the definitive source of data on this, or the nearest to definitive, is the IFSB's Islamic Finance Stability Report. And
Peter, maybe before we get into this, you want to take some questions on the models and the practice?
okay, I can do if you would like me to. Yep, I will still get you to coffee on time. Anything anyone would like to ask about the models and the practice? Yeah.
Just to clarify, in terms of the challenges or barriers that you experience by the intention to create pure mutual Takaful-based products, was it mainly related to the barriers in the regulatory requirements?
I think you will, well, I have not been round everywhere in the world and seen where you have mutuals. You certainly have some more or less pure mutuals in Sudan. In fact, the shares in them are held by banks. That does throw up one other difficulty, which is that corporate law in some jurisdictions may not fully recognize a mutual company. And my understanding, when I've spoken to people in Sudan, is that it is more an issue of corporate law than anything else. But for most places, I think you can find your way through that. But the fundamental question is how you meet any kind of a capital adequacy test on day one. Or even in basic terms, how you pay the rent on day one. Yeah? You've set up your mutual insurer, fine. The landlord, you've got an office, the landlord wants his rent, the staff want their salary. You haven't sold a single policy, taken a single contribution yet. How are you going to do that? Some kind bank going to lend you money? Against what? Yes, of course, you could imagine that if you had a large philanthropic source of funds, organization, individual who says, okay, I'm prepared to put $100 million down on day one, establish a mutual, repay me, of course, with no interest, when you have some cash. I think you could possibly get a mutual off the ground. But it's going to be pretty tricky to do. Incidentally, if you want to talk about those things, that will raise some interesting questions when we hit issues of governance, which I try and take in the regulatory section. But for me, coming out of a regulatory background, the big issue is how you get there from here. And there's no objection, certainly in the UK structure, to mutual insurers. Yeah? We've had the protection and indemnity clubs. We've had a lot of mutuals that have grown over the years. It may have had a disastrous fall from grace, but the famed Equitable Life, subject of many inquiries, was a pure mutual. So you can have them, but they're quite hard to set up in modern times. Okay, let me get on a bit and say something about what I see in the market. I have to say that consistent data are very hard to acquire. I know I once tried to assemble the data for one of the editions of the Stability Report. And in some countries, regulators are very bad at publishing data on, well, frankly, their insurance industry's conventional or Takaful. Sometimes they don't recognize Takaful separately and split out the Takaful data. Sometimes they're just very late. So it's quite hard to get at all the information. I regard the Stability Report, as I've said, as still the best source available, and that estimates an Islamic insurance market. It's often says Takaful, but I'll come back to that later, at 30 billion US dollars in terms essentially of gross written premiums. Now, if you look at the footnotes, in fact, it covers all accepted forms of Islamic insurance, and in particular, Iran accounts for 5.4 billion US of that data. So that is following structurally a conventional model, but with Sharia compliance in other places. Saudi Arabia, with its unique model, accounts for 14.2 billion. Of the remainder, the big one is Malaysia at 4.1 billion. So that's what's out there, and yes, I could go through all the data, but frankly, the report is available online. You can read it as fast as I can. If I look at the market in a little bit more detail, family Takaful is concentrated in a relatively few countries where there is a tradition of saving through insurance. And now those of us who have been around the insurance market know some countries have that kind of tradition. The UK does. Some, and it will be equally true within Europe, don't. People save in different ways. In general, most of the Gulf countries do not have that kind of tradition. So, family Takaful in a relatively few countries. General Takaful, again, if I look around the world, is dominated by personal lines, and particularly by compulsory types of insurance, motor, and in many countries, health. Not saying that's all, but it's what's dominant there. I should also say that in most of the markets where Takaful is present, insurance penetration, whether conventional or Takaful, is relatively low. Now, in some ways, that's good news because it means there's plenty of scope for growth there. And one of the big unanswered questions, of course, is how far low penetration is the result of voluntary self-exclusion by observant Muslims who say we cannot take conventional insurance, and so won't if we don't have to, and how far it is simply that people just don't want to buy insurance at all. But at any rate, it's generally accepted that there is substantial scope for growth. In those markets, I should also say that large commercial lines are commonly fronted. So, if you've got a big factory or an oil refinery or a small airport and you want to get cover for it, in practice, what you will do is go to a broker. And the broker will, in practice, set up the reinsurance first and will then find some local company who will pass the vast majority of the risk through to that reinsurer. My guess is that that broker will probably not go to a Takaful company to front it unless you specifically ask for it. I can also possibly add that I was once on the buying end of that, and it was a commercial line, and we said, well, let's look at Takaful, and a proposition duly came in which the insurance was fronted by a Takaful company, which passed the huge majority of the risk by reinsurance through onto an American reinsurer, which specialized in the kind of business that was of interest. And the contract was that insurer's conventional contract with one page of claimed Takaful terms stapled to the front. Where you found any of the Takaful structure in there remains a mystery to me. However, that was some years ago. With any luck, it's a little better now. Because we're in the UK, I should also say something about the UK Takaful market, which frankly has struggled, certainly in retail. And there's been one really serious attempt to launch a retail Takaful insurer in the UK. It specialized in motor. It lasted about 18 months before it went into runoff. That was 2009. Okay, we all know that motor in the UK is a pretty cutthroat business. That you start a motor insurer that fails, understandable. What worries me a little more is that there doesn't seem, unless I have missed it, to have been a serious attempt in the retail market since. What I think I have to conclude is that British Muslims are not actually that sensitive to Sharia issues when placing their personal insurance. There are not people beating at doors saying, please give us some Takaful in the personal lines market. What I do see is some Takaful here in big commercial lines, and a substantial chunk of this is re-Takaful, and it's in what I know traditionally as the London market, the odd syndicate in Lloyd's, the odd firm doing similar international business, and trying to project itself, particularly in the international market, as offering either cover for the very big commercial risks that are typically placed internationally, or re-Takaful cover. Even there, well, data, as I've said, are very hard to come by, but I think they're finding a bit of trouble growing that business. Moving on to the Takaful market, re-Takaful, well, it works on similar principles to Takaful, with the contributors being the policyholders' risk funds of Takaful companies, typically. And data on that are so sparse. If you think data on direct insurance are hard to come by in some of the Takaful companies, just try finding re-Takaful data. I'm not even going to try and quote them. There are some curious features of this market. When you talk to a Takaful operator, they would sometimes say, well, we would love to place more of our business with re-Takaful companies, but we can't find the capacity. And when people try and start up re-Takaful companies, when I worked in Dubai, I tried to regulate one of them, Takaful Re. They really struggle to establish themselves in the market. And what you typically get is a bit of a slanging match in which the Takaful insurers say, well, yeah, these guys may be out there, but they don't have good enough ratings, they don't understand, they won't quote good enough prices, they don't understand some of the specialist lines that we would love to pass to them. And the re-Takaful operators say, well, really, these direct guys pay lip service to re-Takaful, but they're not in a great hurry to get there. Some of them would even say, oh, and by the way, some of them love their trips to London to place risk here because they can do some things that as good Muslims they ought not to be doing. Now, this is the sort of slanging match you hear in the back corners of the industry. I am in no position to tell who's right and who's wrong, but there is this tension that's going on. Just one or two specialist things first. We've already touched on micro-Takaful. And micro-Takaful is one of the things in which people have placed hope. And this comes partly out of the wish for Islamic finance to make a real difference in the economy, to to provide things that are helpful to the poor. Yes, there is conventional microinsurance as well. And as with conventional microinsurance, you can imagine micro-Takaful as being either produced by a very small group, in this case possibly a mutual, the villagers providing each other with cover for crop diseases, animal infections and so on. Or it can actually be a product produced by a relatively big firm, but targeted at small users. Both exist, both are legitimate, both are things in which people have placed hopes. And by the way, if you want to read more about micro-Takaful, there is a report, I think a joint paper of the IAIS and the IFSB on micro-Takaful. So that's in the research. But unsurprisingly, we're not talking big numbers here. Occasionally, somebody says to me, we've got a Takaful captive. And I say, what on earth do you mean? Because they're talking about a single firm captive. And you say, how can a captive be based on principles of mutual assistance? If you think hard about it, what it is not is in any real sense a Takaful captive. It may be an Islamic captive. It may indeed be ensuring only Sharia-compliant risks and investing in a Sharia-compliant way. Probably not really Takaful. Most of the scholars wouldn't be worried by it, though. They'd say, what is actually going on here really is simply a form of risk retention. Yes, people can retain their risks if they want to. And if that is a good way for them then to channel risk into the re-Takaful market, so be it. So it's a captive. Whether it's really a Takaful captive, who really cares? But it's around in a few places and it's legitimate. And the famous issue, Takaful windows. Now, when I talk about a window in Islamic finance, I mean something that is a part of a company which is also doing conventional business. A part of a company, the same legal entity. Subsidiaries, we understand you can regulate them if you want as standalone legal entities. Do you want Takaful windows? That's fascinating because different people take different views. And one view is that you permit them. And you permit them because, because they allow some big companies into the business, they allow them to utilize their distribution chains and their names. And with any luck, you can spread Takaful faster that way. And Pakistan, within the last relatively few years, has opened up significantly to more Takaful captives after a period in which it tried to stick only to pure Takaful operators. And getting the wider distribution was a motivation for that. There are some places that will not touch captives at all. Windows. Do not go and try and set up an Islamic window in Qatar. They don't like windows at all, and their argument would typically be that this blurs the lines of Islamic finance. It makes it difficult to see what is distinctive about Islamic finance, and perhaps that it delays the point where you can have a purer Islamic finance structure. Oh, and by the way, quite hard to regulate the lines between the captive and its conventional parent. So two quite different views from perfectly reputable Islamic finance jurisdictions. There's another one which says you maybe start with some captives to get the business off the ground, but you hope that later you will convert them to at least freestanding companies or subsidiaries of conventional companies. And that has been, well, still is, the strategy that, say, Indonesia is following. So there's a big debate around that. And yeah, all those points have reputable arguments behind them. The call that any given country might make might well depend on its particular situation. Yeah? Are you trying to get distribution into a lot of rural areas with very small establishments, for example? Yeah. Do you have big companies that will do things? Countries make their own call there. So, I have got myself through just about to the issues about what the Takaful market looks like. I will, at some cost to your coffee time, but I promise I'll try and finish on time later, take any questions about the market, and then after coffee, we'll come back and talk about the regulatory and supervisory issues that all these structures and constraints pose. Anybody?
Yeah, I have a question.
Yeah.
You mentioned several times. Okay, you made mention regarding principle of necessity. Is there any framework that you adopt for companies to be able to determine what is this necessity? Because when this necessity is not defined, you may see companies using this necessity principle in other way or to their benefit.
Yeah, I will come back on that issue later. However, necessity, darura, is a Sharia principle, and fundamentally you look to Sharia scholars to say when and how that principle can be invoked. From my point of view as essentially a secular regulator, I am not going to determine what the answer to that is. What I might do as a secular regulator is say, has this Takaful operator taken a proper Sharia advice, come back to what that means later, on that principle? Has it, since the invocation of that principle is, as I understand it, always contingent on a given set of facts, has it asked the Sharia board to review it if the facts have changed? So I can ask questions about governance, but certainly as a secular regulator, I am not going to tell anybody what the answer is. But I will return to it later, I promise. Dr. Bello, yes?
Yes. Thank you, Peter. All right. So maybe perhaps in certain jurisdictions, what the regulators do is that they clearly provide a detailed guidelines on set of criteria, so which will guide the Takaful operators to determine what is a necessity or what is not. But upon all that, still, if there is a Sharia committee of the Takaful operators or the Sharia board, this issue has to pass through that, and there should be a clear recommendation from the Takaful Sharia board to the regulator for the regulator to be able to take an informed decision. But there is no regulator that will just allow the Takaful operator a free hand to decide on what is necessity and what is not necessity. Otherwise, you will have some Sharia compliance risks there, and then there will be some issues that may be arising.
Yeah. Azra, you wanted to ask a question.
Can everyone hear me? Thank you, Peter. That was really enlightening. I'd just like to offer some, hopefully, benefit of my experience in the UK. So I've been, like I said, working in the Islamic finance industry for nearly 20 years in the UK. And as part of that journey, we did try to get an insurance, a Takaful insurance scheme off the ground under the brand of Insure Halal. Some of you may be aware of that in this room. And it worked quite well in the sense that it was home insurance. We use a kind of InsurTech platform. And actually the essence of it and I suppose the business model and everything else was working reasonably well. It was early days. Unfortunately, it fell apart on two levels. One was that the tech provider we teamed up with, because it was a startup and we didn't have a lot of capital, so we tried to do things in such a way that we collaborated with different players. Unfortunately, that tech provider kind of dissociated himself from the entity. He wanted to go in a different direction, and that caused us a big problem. And then the actual capacity provider, which is unrated, is an offshore provider, LAMP, they decided to also come out. So it was a case of, things fell apart as a result of that. But my experience, for the benefit of this audience, was to say in Europe, there is not much Takaful provision at all, despite there are people today here and listening in, I think, on Zoom. I'm talking to some people in France, for example, about how we can collaborate and do something. But I think for me, in insurance in particular, in financial services in general, trust is a big thing, especially when people are taking out protection. And I think the way to go because Salam Insurance, which you mentioned, was a situation where there was a lot of money that came in to establish an insurance company from scratch. And as you know, insurance needs a lot of capital to establish something. But I think a more smarter model is to actually team up with a reputable insurance company which has a rating, has a reputation, and do the window model in the UK. And I think there is some appetite for that. And I think that way you get trust because people recognize names which are household names or at least rated. Secondly, you get the experience and the underwriting and everything else that goes with an insurance. But then you obviously structure the product in such a way that it is compliant with the Takaful principles. And I think in minority countries like the UK and in the sort of Western world, perhaps that's the model to go with. That's certainly what I'm looking at and exploring. But if anyone has any other ideas, I think, as you said, there's hardly any provision in the UK or in the Western world of Takaful, and that really needs to be addressed. And it's not, from my experience of serving the retail market, it's not because people are ambivalent or don't care if they don't have something. It's the fact that there's nothing in the market, so where do they go? I mean, the retail market, if there was a decent product at a decent price with good service and good credibility, people would go for it. But there just isn't provision. So I think there's a real opportunity here. It's a massive challenge, but a real opportunity to do something in Europe. Yeah, that's my observation.
May I suggest we take our coffee now? When would you like us back?
Actually, if we can take 10 minutes, that'd be great.
Okay.
Yes.
10 minutes. Okay. From this.
Okay. Okay. Ladies and gentlemen, we are about to continue. The organisers have asked me to tell you that you are very welcome to bring your coffee and your sticky buns back in here. They have also asked me to tell you that they have found a sum of money on the floor. So if anyone has lost money, would they please have a word with Ibrahim or Heshem and tell them what they know of the details. Okay, right. I have had coffee, yeah. Okay, let's get underway. Just in case people didn't hear me the first time, the organisers have found a sum of money on the floor. If you think it may be yours, would you please speak to Ibrahim or Heshem? Also, one or two people asked me whether my presentation was going to be available online. I understand that the organisers will be posting it on their website at some point. But if you want any more, just contact me. Now, in this second session, I am going to be talking about regulatory and supervisory issues. The session title is a sort of homage to the first paper that the IFSB produced on Takaful, and that was a joint issues paper with the IAIS, International Association of Insurance Supervisors, and it was partly to delineate a work program that would follow, but it was also in part a piece of diplomacy in which the two organizations got comfortable with each other, and in which the IAIS effectively accepted that Takaful was an interesting topic, but it was one where it would leave the IFSB to deal with the Takaful specificities, and the IFSB standards would essentially follow those of the IAIS, except where there were specificities. So that's, as Dr. Bellows already said, the way those organizations work together. That paper was published in 2006. And I was representing the IAIS, not the IFSB, on the working group that put it together. So, what do I think are the key regulatory issues? Well, I am going to try and focus on those regulatory issues that have the greatest Takaful specificities, i.e. the places where Islamic insurance is really different. These are a set of topics that I think delineate those areas, And I'm also going to touch on two emerging regulatory issues that seem of particular interest. One of them being climate-related and other sustainability matters, and the other being resolution and recovery. Now, the IFSB has done a lot of work in this area. I list 6 standards here. There's one I'm saving up, and there's one that I have omitted simply because the issue of solvency has been the subject of 2 standards, and I have quoted the more recent one. In addition to those 2 standards, there are a couple of standards that apply to several sectors of Islamic finance. One on conduct of business, which gives examples across the 3 major sectors, and the fundamental one on Sharia governance, due soon, we hope, to be replaced, but I quote the current version, and that applies to essentially all Islamic financial institutions. Now, I said there was one I had left out. This is the big one, and that's core principles for Takaful. Now, those of you who are sort of regulatory nerds will know that the major international standard setters tend to have core principles. And if you pick up the Basel core principles, they are like 60 pages. Those are core principles and some evaluation criteria broadly. The IOSCO ones are a bit longer, but not much. If you go to the IAAS, however, they have structured their core principles differently. And they have put essentially all their standards into that text in some detail. And IAAS core principles are 400 pages, give or take about 2. The IFSB core principles for Takaful are of broadly similar length, unsurprisingly. And so a lot of the IFSB thinking on Takaful will be found in significant detail in that one standard. Not all of it, but that is the key source there. Not surprisingly, I am not going to go through 400 pages of regulation. So what I'm going to do is talk about what I see as the big regulatory issues. I do so, again, in part in acknowledgement that I'm in the UK. And I say, although the UK has done a great deal for Islamic finance in a number of ways, for example, in sorting out the tax system to give proper tax neutrality, it has not incorporated very much, if anything, within its financial services regulatory arrangements. So it wouldn't be appropriate for me to be saying, how do you implement a very detailed set of standards? Rather, I should be talking about the issues that they raise, that are dealt with in those standards. I should also add there are further IFSB documents, including some research documents, which go under the title of working papers, which are also relevant to Takaful. Now, I guess the big issue in any bit of Islamic finance is Sharia governance. And that is intended to answer the question, what is it that gives us confidence that firms or products that claim to be Islamic really are, or at least are making that claim plausibly? And the answer, of course, is Sharia governance. And in practice, that means the use of one or more Sharia scholars to give a ruling on a practice, a structure, a transaction, whatever it is. Okay, fine. As a regulator, what do we expect? Well, the first thing to say is that many firms will put Sharia governance in place for market credibility reasons, even where there's no regulatory requirement. So, for example, An Islamic bank, a Takaful company in the UK, will put in place Sharia governance. But there's no regulatory rule that says it has to. It needs to do it for credibility, but that is, at least in law, a voluntary decision. And some regulators cannot or will not take an interest. Some cases it cannot. Some believe that their constitution even prohibits it. You know, if you talk, I've talked to the US SEC about Islamic capital markets. And they say, we cannot possibly touch this. France will occasionally say, we have a secular constitution, we have a problem doing this. So some will conclude that constitutionally they can't touch it. Some find themselves politically unable to do so, or conclude, frankly, there isn't enough Islamic business in the country to be worth the effort. Where there is at least some appetite to become involved, there are at least two approaches that are followed. One is to have a national Sharia board. The other is to have individual Sharia boards in the individual Islamic firms. And of course you can do both of these, and many countries do. There are some that do only one of them. And jurisdictions may take more or less interest, particularly where it's within individual firms, in how that Sharia governance is functioning. Not saying that's good, by the way. I'd like to see proper Sharia governance, but around the world I don't find it everywhere. So the exact relationships vary. There are some countries that have slightly unusual conditions. For example, Morocco, I think, is still allowed only one Sharia board for the entire country for all subjects. It has had to find a way to create a specialist committee of that for Islamic finance. Turkey, I believe, and I defer to my Turkish colleagues here, again, find constitutional difficulties in having a national Sharia board, but have managed to establish something that functions at a national level within a trade association. So there are ways through some difficulties and some unusual arrangements. But that is what we need. And typically, a Sharia board in a firm will have a minimum of 3 qualified scholars. In one or two places with very strong national Sharia boards, they may have less. Some of them will have some non-scholar members. Typically, in countries where the Sharia scholarship tradition in financial services is not strong, they may think they need somebody to advise them on the financial services aspects of what is going on. Often they will be excluded from actually voting when a ruling is required. Typically, they function somewhat like a board committee. They have a slightly similar relationship with the board. And you would expect them, in a well-governed structure, to be supported by a Sharia compliance unit, whose job is to make sure that the decisions of the Sharia board are actually carried through within the company, a Sharia audit unit, which does roughly what a normal internal audit would do, and goes through and checks that that's happening, and some sort of annual Sharia review, which may be done by external practitioners, may be done in some other way, but under the authority of the Sharia board. So that's what you expect broadly in Sharia governance. Now, in the corporate governance sector more generally, of course, the main issue that I as a regulator will think about is how that Sharia governance structure relates to normal board governance, given that regulators always want to pin ultimate responsibility for the running of the company on the board of directors. And so they will want to see proper channels of communication between the Sharia board and the board of directors, and the board of directors at least taking a high-level interest in what is going on, but seeking the advice of the Sharia board whenever necessary. That's the obvious thing. I flag two more, only one of which I've put up there. One of them is that if you have an embedded Takaful structure, I keep saying that there's this policyholders risk fund thing, and maybe a policyholders investment fund, which in principle belong to the policyholders. How does the board exercise fiduciary responsibility towards those policyholders? Yeah, when it's making investments, how does it determine how they will be attributed? So what is the thinking of the board as fiduciary for the policyholders? The issue I didn't flag, but it came up in a question I was asked, is, and what happens in a mutual? Well, there is no, if you can manage to establish a pure mutual, there is no real problem in that mutual electing a board of directors. Plenty of mutual structures in which it is done. I would say that mutuality does not overcome necessarily the fiduciary issues. And one of the things that we've seen is that in some cases it is very hard for the members of a mutual to exercise any degree of scrutiny over what the board of directors are doing. And the board of directors may be driven by their own motivations, maybe just to make themselves look good. And I suppose I am hardened a little by the famous case of Equitable Life, a pure mutual life insurer in the UK, which failed badly in governance, and yet it's a pure mutual. Furthermore, it was set up specifically originally for people in the legal profession. So its members are stuffed with good lawyers, top QCs, members of parliament, judges. And even so, the problems of governance were not simply solved by mutuality. Okay, so that's corporate governance. Now, capital adequacy. I was a prudential regulator, so the thing that really bothers me in any insurer is it going to go bust and leave the policyholders' claims unpaid? Now, the main issues here for Takaful come from the fact that you've got at least 2 pools of funds. You might have more. And in principle, following the sort of structure I sketched out earlier, each of those funds has certain pools of assets and liabilities that are attributable to it. By the way, if I were a regulator in some places, I would scratch my heads a bit and say, yeah, that's what the principles say, but is that going to be upheld if we ever go to a court? If the landlord decides to sue for his unpaid rent, will the court say, you can go only to the shareholders' funds for that, you cannot touch the policyholders' funds? So the interaction between secular and Sharia law here may get interesting. But if I think that there is a good separation, then am I going to apply capital adequacy tests to each of those separately? Now, that is in many ways what you would like to see happen. And since your concern is particularly for the policyholders and to make sure that they get paid, you will want to look particularly at the adequacy of the policyholders' risk fund. And you can find these things discussed in considerable length in the IFSB standards on capital adequacy. But hang on a bit. Why have we got these external shareholders involved here at all? Well, we've got them because it is very hard from the outset for the policyholders' risk fund to be self-sufficient. Okay, it might get there over time, but you've got shareholders' money in there partly to support it. How is that articulated? And first of all, how is it tied in? How do you make sure that if there's been a bad year, the storm has ripped through, roofs have come off houses, trees have dropped on cars. If you've got a bad year, how do you make sure that shareholders' money really is there to pay the policyholders' claims? Okay, so how do we get that shareholder capital support in? Well, I've said the usual way is via an interest-free loan card. Often, in practice, regulators will make it a requirement to provide that money. They may do it by writing something into their rules. They may do it by requiring some kind of letter of support within the company. But in practice, it will often be tied in by the regulator. But okay, that's money that's sitting in the shareholders' fund. Next question is, when does it have to be paid down into the policyholders' risk fund? And there are broadly three answers that people will give you. One of them says, we are going to apply a capital adequacy test to the policyholders' risk fund, and we want its actual paid-in assets to exceed its liabilities by such and such a margin. I mean, that's a very simple test. It'll be a more complex test than that, but that's what it'll amount to. So you can say, pay it down the moment the PRF is about to fail a capital adequacy test. Second answer, well, doesn't need to be quite that early. We will accept it as being earmarked in the shareholders' funds. Pay it down when the liabilities of the PRF exceed its assets. I.e., when in balance sheet terms, it's bust. That's a second answer. Third one is pay it down when that fund is illiquid. So when it actually doesn't have the funds today to pay tomorrow's claims. That is usually at a much later position because it's a characteristic of insurers, especially general insurers, that they are normally insolvent way before they're illiquid. The storm has ripped through, the roofs have come off. They know they're going to have to pay a lot of claims. They may know they haven't got the money to pay them, but they don't have to pay them this week. The builders have not started putting those roofs back on. People have not got quotes for repairing their cars, let alone had it done. So generally, this is the last of those points. Takaful operators hate the idea of paying the money down early. The reason for that is that fundamentally, it's not doing them any good. Instead of earning all of any profits you've made from investing that capital, you are getting at best a Mudarib share for it. So they really, really don't want that money tied down there for a long time. But then, how do you make sure it's there? How, as a regulator, do you stop it disappearing? And look, regulators are cynical guys. They tend to say, if the company is getting itself into a bit of a struggle, won't the shareholders be tempted to pay themselves an extra dividend, get their cash out before it collapses? So that implies you need to apply some test, either to the shareholders' fund taking account of its commitment, or to the company as a whole. One of the other really, really difficult issues in capital adequacy is, if I state it in technical terms, does CARD have gone concern loss absorption? Fundamentally, you've paid this money down, let us suppose, into the policyholder's risk fund, and you're still deeply in the hole. The company is bust. What about that card? After all, I've talked about it as an interest-free loan. Any good accountant knows that a loan is a liability in the fund. Even if I can find some way of fudging this for a capital adequacy point of view, do the shareholders have any claim on that money they've put down? Well, most typically, the Sharia scholars will say they do. And so I worry, as a regulator, about the loss absorbency of card. And that is something that any regulator will ask questions about. Tied in with this, tied in with card and with another issue that I'm going to touch on is, where do you think you are going in the long term? And this has to do with the fundamentals of Takaful. Is what you really, really want to have in the long term a mutual insurer, which may be managed for you by a set of professionals, but they get their money from their management, not from having their capital at risk. And so although it's very hard to start a pure mutual, is that where you're trying to get to? If it is, you want that policyholder's risk fund to get as solvent as it can, as fast as it can. If you say, well, actually, that's very difficult. We're happy with this sort of hybrid position where there is a shareholder's fund that is a key part of the solvency, then you're a bit less bothered about that. And this affects a lot of things, like when any card should be repaid, if ever, when it should be paid down, and what other payments can come out of that fund. So just keep that question in mind when you look at some of the other issues. Because one of them, which was raised with me before we even started, was, well, what restrictions, if any, are applicable to distributions from the policyholders' funds? Now, as a matter of observation, firms in some countries are quite keen on making distributions from policyholders' funds, and they see it as one of their unique selling propositions. As a matter of observation, companies in some other places are much less keen on doing that, or maybe have been prevented from doing it. There is, by the way, an IFSB working paper which studies patterns in this, and it's worth having a look at. But there's all sorts of issues here. Yeah, maybe you say, if this was a dreadful year for the policyholders' risk fund, yeah, the storm, etc., and it's made a loss, then maybe the case for giving anything back to the policyholders is pretty weak. What happens, however, if this was a good year for the policyholders' risk fund? No major storms, no bad weather, yeah, a definite underwriting surplus. Unfortunately, however, you're still in the hole from 2 years back. You've still got card outstanding from the year when you did have the storms. In that situation, can you legitimately repay some money to your policyholders in recognition of this good year, or do you wait till you're out of the hole? So there are some issues around this which are very difficult, and I would suggest that a regulator's response will depend in part on where they see the Takaful entity going in the longer term. Another smaller issue, do policyholder interests ever require you to have more than one policyholder's risk fund? Suppose you've got some different business. Suppose you do find yourself in your Takaful firm, perhaps fronting, but taking on some bits of some big commercial risks. Maybe the airports authority has asked you to cover its airports, and you've got a couple of small private ones. And at the same time, you've got a lot of small retail policyholders. Do you put those together in the same PRF? Risk diversification, incidentally, suggests that that will reduce the overall volatility. But do you then say, well, it's unreasonable to keep these two very disparate collections of risk together? Again, different people will give you different answers. It's a question. A third issue in capital adequacy, which I've already suggested, is how you do asset liability management with fewer available investments. Remember, not all those big conventional bonds around, and with limited use, if any, of derivatives. And I've already given the example, if you've got currency risk, for example, you're doing some business that's traditionally priced in dollars, but dollars are not your currency, then how do you manage that bit of the risk? I now turn to Takaful. And of course, in some ways, the issue is rather similar. I've already said you're following similar principles to Takaful. But the higher volatility typically associated with reinsurance or Takaful probably means that you're going to need even more capital available. Yeah, somebody said to me the conventional reinsurers basically just rent out their capital. You're going to need a lot of capital, and are you going to need it all in the policyholders' risk fund? If you follow the sort of principle that you want a 1 in 200 years probability of inadequacy with relatively high volatility, then you're going to have a lot of capital there. And if you're growing as well, that's even worse. So the shareholders get very nervous about that. So it's a bit more challenging. There are also some other bits and pieces going on. Remember, I said that in anybody's decent view, and certainly in the view of the IFSB standards, you pay for Takaful out of the policyholders' risk fund, and the recoveries go back there. But there are some sneaky things around, like ceding commissions. If you're getting ceding commissions out of your reinsurer, Takaful entity, whatever it is, where do they go? Well, in my view, they go back into the policyholders' risk fund, but there will be a few people tempted to take them out by some other means. That it becomes effectively a way of siphoning the policyholders' money out of their risk fund. Sort of thing you watch for. One of the other issues that pops up occasionally is whether a Takaful undertaking can accept business from a conventional insurer. The usual answer when you put this to scholars is yes, it can, provided it believes that that business is itself Sharia compliant. Of course, if that's the answer your scholars have given you, that's fine, but you're going to have the question, are there systems and controls in place to make sure that it really is compliant? Easy if you've done a straightforward facultative piece of reinsurance. You know exactly what you've insured, but if it's a treaty, are the people that are ceding it to you very careful that these buildings that are being covered do not include a brewery or a conventional bank or any of the things that you don't want? So there are systems and controls issues in ensuring that a Takaful operator maintains Sharia compliance of the risks. Now, I dealt with the relatively easy issues. The big issue around Takaful, and please read the IFSB standard on Takaful, is when a Takaful undertaking can cede business to a conventional insurer. We've discussed this already to some extent, and the principle of necessity may allow this. The question is when. Probably if you are ceding a really specialized risk and you need a reinsurer that understands, shall we say, satellite risk, because your local telecoms operator wants coverage for their satellite, then it is possible that a Sharia board will say yes. As Dr. Bello has said, in some cases there will be national guidelines. In some cases there may be a national Sharia board which will take an interest. In some cases, if you're standing in and operating in this country, there is no national regulatory rule bearing on it, but you will hope that the Sharia board has been properly consulted. So my question as a regulator will be, is there proper Sharia governance in place to make sure those questions are properly put? And, trickily, is the advice regularly reviewed? It may have been contingent on, for example, there is no Takaful operator that specializes in this area. 5 years on, that may have changed. 5 years on, the rating or the pricing of the Takaful operators may have changed. So one of the things that you would expect is that the Sharia board will revisit its rulings at frequent enough intervals to be sure that its basis is valid. Okay, I move now to conduct of business. Now, here the specificities are mainly around the sales process, especially, of course, where you are dealing with retail sales. And in some countries, potential policyholders may be unfamiliar with Takaful. Yes, of course, Islamic finance places great emphasis on clarity of contract, but even conventional insurance contracts aren't that easy to read. And it would be very easy for someone buying things to say, oh yeah, this is insurance, I understand what's there. Actually, they're signing up to a slightly different, materially different set of contracts and should be aware of them. Are any expectations being created in that sales process about distributions from the policyholders' risk fund? It's one thing to say this may happen, but there is no right to it. If you say, yeah, this may happen, and in the last 10 years we have done it in every year, are you creating an expectation which exceeds what you may be able to deliver? And where there is an agent of any kind, a broker, whatever they call themselves, involved, how does that intermediary take account of any preference that the customer may have for an Islamic solution of some kind or not? Because it may well be that Joe Public in some country goes to his insurance broker and says, I need coverage for my new car. It may well be that there are Takaful and conventional offerings available. How far is that intermediary under any obligation to take an interest in whether Joe Public has a preference for one over the other? So those are the dominant issues that I see in conduct of business. Transparency and disclosure. Well, there are disclosures, of course, in the sales process, and I touched on some of those. The market disclosure issues stem mainly again from the separation of funds. So when you're putting your annual financial statements out, and it's being read by shareholders and analysts, what do you need to disclose about these separate funds? After all, in principle, they belong to different groups of people. But on the other hand, they have linkages that are relevant to capital adequacy. So in general, you would want to see disclosures for the funds separately. And so one of the issues, again covered in the standards, is which disclosures need to be made at fund level. Other issues here, disclosures for windows. Now, as it happens, someone a couple of days ago asked me, what disclosures do people make about Islamic windows in the UK? I struggled to find her a good example. Fortunately, there are some countries where I can get sensible answers, and I showed her a few. But how far do you regard that window as a ring-fenced entity about which separate disclosures need to be made? Again, I would tend to say, yeah, it is a separate entity. You want those windows disclosures, but do you always get them? Not necessarily. And I'll touch briefly on, in some sense, ESG disclosures. I'm not being fussy here about whether this is ESG or sustainability or where the lines are. But you hope that if Islamic finance claims to be a principled system, it will, for that reason, if for no other, make disclosures. And in fact, the relevant IFSB transparency and disclosure standard does mandate across the ESG spectrum a set of broadly processed disclosures akin to those that the Task Force on Climate-Related Financial Disclosures requires simply for climate. So the IFSB standards have broadened somewhat the applicability of those disclosures. Now, two emerging issues. Climate is getting to be an interesting issue around the whole of Islamic finance.
Can I ask a question, or should we leave it at the end?
Yeah, by all means.
Yeah. I mean, going back to your, first of all, thank you very much. I think it's quite comprehensive and very detailed presentation. I'm grateful for that. Now, going back to the disclosure.
Okay, let's see if I can get back. Yes.
Now, the windows do not have their own regulated or legal structure as such. So they would fall within the entity under which they sit.
Yes.
As a window. So the same disclosure and, or whatever other, regulatory or the legal application have to be applied, in my humble opinion, the same would apply to that as well.
Okay.
So therefore, I don't think we need a separate disclosure for the windows because they don't have any separate structure as such. They just sit in under the parent group or whatever it is.
Well, I get quite nervous when you say they don't have any structure, because one of the things... Right. One of the things that we most... After all, if you want that window to be considered as Sharia compliant, then there must be things you can say about that window that you cannot say about the conventional entity in which it sits. And that is probably more than simply what risks does it cover, but is there a concept of there being a policyholder risk fund within it, which belongs to the policyholder and which is available to meet their risks and no others? Does it have investments that are attributable to it and that you can say are Sharia compliant? And do they match up? What are the channels by which it interacts with the conventional parent of which it's a part? Now, those are all very, very difficult issues. And look, if I look around the world, I will see some places in which the Sharia scholars have given the windows a ring fence around them, which make them look almost like separate companies. And I will see some places where there are very, very weak ring fences. But if you want to be able to claim that this entity is Sharia compliant, beyond the basics of saying, we don't insure breweries, then exactly what claim is that in structural terms? If I may, I will continue, and I'll happily return to those issues later. On climate, there are two real issues here. One is the impact of climate change on the Takaful undertaking, and you're talking here classically about physical and transition risks. And then there is the one about what impact the Takaful undertaking has on climate in terms of where it invests and so on. Clearly, The physical risks particularly are material for any kind of insurer. Yes, you can say a general insurer normally does single-year policies. Why is there a big issue about the physical risks? The trouble is, one of the things physical risks do is increase the probability of very rare events. Yeah, and if you used to get a tropical storm once in 100 years and now it's coming down to 1 in 50, that has increased your risks, but that doesn't necessarily show up in the year-on-year figures for the years where you don't get a tropical storm. So there are some real issues here. So far, the jury is out, I think, on whether there are material Islamic specificities to these. Sorry. Tail end of a cold. Which is why I won't talk about them now in too much detail. But the claim that Islamic finance makes to be a principled system means you would certainly expect Takaful undertakings to be thinking seriously about the second group. Oh, okay, thank you very much. The even more tricky issues are resolution and recovery. And anyone who has, thank you, dealt with insurance in any kind of difficulty knows it's a nightmare anyway. And insurance insolvencies are a real problem, mainly because of the timescales for the determination of liabilities. You know, I kept saying, you've got the storm come through, it will actually take a while before you know how much the damage is going to cost. And if you've insured something like a liability class, you've insured some pharmaceutical supplier whose drugs may turn out to have unforeseen long-term effects, they can take a very long time. So insurance insolvency is tricky without even having Takaful there. On the other hand, you'd think Takaful ought to have an advantage because you've got a nice separate PRF, and with any luck, you can transfer it to another Takaful operator. There are a couple of tricky issues here, though. One of them is that contract novation in Sharia can be tricky without having to get the consent of individual policyholders. The other goes back again and again and again to the issue that Sharia tends not to recognize priorities between creditors with equal security. And this means, once again, can you give the policyholders preference over, say, the shareholders' claims to be refunded their card? Now, I can only flag that because fundamentally what you're dealing with here is going to be the interaction between the secular law of the country and Sharia law. And you know, I've asked the question before, will the courts recognize a segregation of funds? Even as between policyholders and shareholders? And if there's more than one policyholder fund, will they recognize a segregation between, remember, those airport policyholders and the retail policyholders? Associated with that, will they recognize any hierarchy of creditors? And I've centered this around a liquidation. You're saying, why do I do that? Why aren't we looking just at recovery and perhaps some sort of bail-in of somebody? And the answer is that when you're thinking about recovery, you normally think about liquidation as a worst case and are trying to get to a sort of no creditor worse off situation. Well, you can only do that if you know what the worst case is. And fundamentally, we don't know what the worst case is. And I have to say, I think there is no practical experience. The good or bad news is that where Takaful firms have got themselves into trouble, they've either done it early when they can run off, or perhaps there has been some quietly engineered white knight buyout. And regulators in some jurisdictions are quite good at doing that. Okay, the very last bit, supervisory issues. What would I be thinking of as a supervisor? Yes, of course, I want to see whether the rules are being observed. I want to see whether the numbers add up. But often the rules are fairly general. Around corporate governance, they very commonly are. And so I will often want to see how things are working. How is that corporate governance working? I can see what the manual says about Sharia governance. What's happening on the ground? Yeah. Do I want to go in and get the papers for the last Sharia board, for example, and see how issues were put to them and what sort of resolutions they made? Another thing that I worry about is misaligned incentives. Because if someone's incentives are misaligned, they may be very tempted to do the wrong thing. Now, I shall come back to that in a moment. I want to look at flows of funds. I gave the example of seeding commissions for Takaful. I'm always interested in whether the managers are trying to get the money away from the policyholders. That will be the key one. And then I'll say a couple of words about runoff. There are also some issues in family Takaful, Takaful windows. I've talked about ring fences. Are they being observed? And resolution. The what law will apply will be an issue for you even if you haven't made any rules about it. I will touch on some of those issues, but in the interest of time, not all. So, Sharia governance. How is the Sharia board operating? And I've already touched on, do they go back to past rulings when circumstances change, especially if they have invoked principles like Darura? Do they get full information? How do they communicate with the board? That's the sort of thing you might get by going in and, as I said, pulling a set of papers, maybe pulling a set of the board papers, seeing what they are seeing from the Sharia board. Misaligned incentives. The separation of funds is tricky. I already have a glass, thank you. Is tricky because where you have that separation, the managers are paid by the shareholders. And one of the things that may happen is if shareholders' funds are not at risk from bad underwriting, then what incentive do they have to good underwriting? More to the point, they are getting, at least in the structure I showed, a wakala fee. That's a percentage of premiums. Arguably, their interest is to get the biggest volume of premiums they can. Anyone who's knocked around the insurance market knows that the usual way to get a high volume of premiums is to cut your price. You're the cheapest in the market. You get a lot of business very fast. It may be thoroughly unprofitable business, but you get it. So we have seen conventional insurers crash and burn by doing that. So is there a temptation to write for volume? Well, if there is, there are a couple of things that may mitigate it. If you do get some kind of a success fee, well, that will help because you want the underwriting to be profitable, in surplus, technically. If you are going to have to pay down some card, if you are underwriting badly, then that's another good reason. These things are interesting because they tie the shareholders' interests and the policyholders' interests more closely together, but they do it at a price, and that price is a departure from the purity of the Takaful model. They take you further from its being a mutual that is managed which may be where you want to be in the long term, and closer to a conventional insurer where fundamentally the shareholders' money is at risk from the underwriting. So this stuff is tricky. What I would want as a supervisor is to see what is actually happening on the ground. Are people behaving as though their incentive is to get as much premium through the door as possible? Or are they behaving in some different way? Flows of funds. Well, I've touched on Takaful insurance transactions before. There's a couple of other things. Yeah. Are there any loans between funds? Are assets being transferred between them? Yeah. And if Fund A, say the policyholders fund, sells an asset, holding in some sukuk perhaps, to the shareholders fund, does it do so at a fair price? So a number of questions there on valuation. And as I've already said, in the case of an Islamic window, I get very interested in the flows between the Islamic window and the conventional part of the company. I also get interested in shared costs. Yeah. Not only who is paying for which bit of the staff, but suppose that they have taken jointly some piece of reinsurance or even Takaful. Might be sensible. They've got some household policies written conventionally. They've got some written Islamically. There may be a Takaful operator that will give them a better price for putting the whole portfolio into reinsurance. But then, are the costs properly attributed between the two? So whenever I see a ring fence, I want to see what's crossing it and why. Runoff. Yeah. I once had the misfortune to have responsibility for a lot of insurance companies in runoff. You don't really want it, because in runoff there is always a temptation for shareholders to extract money. Fundamentally, they've got pretty little to gain from keeping money in there, and if they can find any excuse to get money out, some of them will. Not all. Some will operate with high principle, but some want to take the money and run. So there are a number of ways they can do that. Some of them are common to conventional. But will they have a temptation to extract any card that they've paid down? They may do. And the issue I've already flagged, under what conditions can policyholders be transferred to another operator? By the way, what you don't want to do is to transfer your policyholders into a ship that's even leakier than the one they're in already. So if they're being transferred, is it something in a way which improves their chances of getting their claims paid or worsens it? New business strain. We all know probably that new business strain is a common issue with particularly life insurance, because the cost of acquisition, what you pay for advertising and brokers and all of that to get someone to sign up to, a 20, 25-year policy, is a very high proportion of the first year's premiums. And if they stop paying you, either they withdraw formally or they just walk away from paying the premiums, you can be in a situation where you've shelled out a lot of money to get the business and it hasn't come in. That's common. People usually find contractual ways with, say, their brokers to minimize the risks. The one way in which it will be different in Takaful is if the money has been paid into the PIF, Policyholders Investment Fund, if that is held to be the money of the policyholders, then if they withdraw, are they actually entitled to a significant amount of the money back? Does that make your problem even worse? Something I would keep an eye on. And in any event, supervisors always like to look at withdrawal rates, particularly from life policies, partly because of new business strain, partly because it may also indicate they were missold in the first place. One final comment, really. Where there is regulatory goodwill, I think most of the issues can be managed even in a system that has not responded strongly to Takaful. And there are places, as I've said, that find it very difficult to change their regulatory system. Yeah, if you go to any company in the EU, it will say, we could only change our rules if we get the whole of the European Union to do it. We can't actually do very much. They will find ways through if they have regulatory goodwill. The big but, however, is that they will typically do that in ways which blur the difference between Takaful and conventional insurance. They will look at all the money in the firm. They will perhaps not take very much interest in Sharia governance. There will be much more weight on the company to behave in a proper way. And it is, after all, exactly because you would want the regulatory system actually to be a bit different, that we have something like the IFSB, that we write standards, that we hope that as many jurisdictions as possible will implement it. Because eventually this is about preserving the difference between Islamic and conventional finance. So, there I leave you, my presentation. I will happily now try and field any questions. Am I right in thinking I've got till about 1 o'clock if I need it? Yeah, okay, yeah. Yep, so I can see there's a few questions coming from the other side as well.
Yes, thanks, Peter, very much for this brilliant presentation. I got a question like, you know, Takaful industry has lots of challenges, hundreds of challenges.
Yeah.
But one of them, which is trust and confidence in the product. So if I am a customer and I read about Takaful, when I buy my Takaful policy, it says that you will get a surplus by the end of the financial year. So most companies, like probably in Malaysia, they do pay a surplus to the policyholder, but there are many companies, many Takaful firms. Let me be very clear: in the GCC, they don't give surplus to their customers. So, as a regulator here in the UK. And you know, we got here the very sophisticated regulation in the insurance sector and very tough and very well monitored and watched. So if you are the decision maker for the regulator, how are you going to look at this perspective? Are you going to incorporate this as something that Takaful firm will do it mandatory? By the end of the financial year, they have to disclose. Have they distributed some of the surplus to the policyholder or not? Or are you going to leave it like loose, like what's happened in some countries? And this is, I think, a major issue for the customer to build up trust for the Takaful to grow and to expand.
I think I may have to duck and weave on this for a couple of reasons. If I were doing it in the UK, I would be doing it, of course, within a conventionally designed regulatory system. I would have the benefit of no rules to guide me. I would be operating within a capital adequacy system closely based on Solvency II, even though there are some fairly small modifications. If I was sitting in the PRA, the question I would be asking myself is this a distribution which impairs the capital adequacy? Now, I might have to take into account here whether the past pattern of distributions creates a policyholder expectation, but in that case, I might expect the expectation to be reflected in what is held in, as part of the capital adequacy test. So that will be if I'm sitting in the PRA. If I am sitting in the FCA, my issue is conduct, and my issue is, are the representations that are being made to the policyholder fair representations of what actually happens on the ground? And yes, I might be worried if representations are made about distributions that are not then carried through. So my interest would be different coming from those two directions, but doing it entirely within the context of a conventional regulatory system, which, for example, does not treat the policyholder's risk fund as separate from the shareholder's fund. To a certain extent, from a capital adequacy point of view, my interest in those circumstances would be what money is leaving the company. And, you know, it's left the same way if it's gone to the policyholders or if it's been paid in dividends to the shareholders. Now, I am not saying that that is the regulatory system I would want to be operating, but that is because I consider that those pools of money belong to different people and that you want some capital adequacy in the PRF. However, you know, if you then say, how would I approach this in a different jurisdiction? I would then have to say, first, what is the regulatory regime in that jurisdiction as regards both conduct and solvency? And also, what are the positions of the companies in question? By the way, what is the regime also includes what are the understandings, for example, in terms of letters that regulators may have required from companies. I can't answer that in the abstract.
Thank you.
Yes.
Thank you, Peter. Can I have the mic on? I think. No, I have a mic. All right, it's good. Thank you. I think, thank you, Peter, and it is really an important question, and actually, that's really the main issue that's not only in the UK, globally, Takaful companies are facing. And as Peter rightly mentioned, depending on the regulatory regime, in most jurisdictions, they allow the Takaful operators to have a clear disclosure requirements, which the supervisors come from time to time to check. Because we have a situation whereby the Takaful operators, when they are selling or they are looking for contributors to the policy, they make this kind of promises. But after then, the disclosure requirements are not being adhered to enhance the transparency that will build the trust. So this has been the issue. We have, the hybrid model of Mudaraba and Wakala is one of those. But you have more complicated models like the one that has Juala in it, whereby there is an incentive for the Takaful operator to benefit from the surplus distribution by default. So in such kind of situation whereby the surplus distribution is not only going to the policyholders, but as well the Takaful operators has some benefit in it, they do try as much as they can to ensure that the investment fund as well as the risk fund, when aggregated, has some surplus for distribution. So, but I think what the regulator will always request the Takaful operators to do is to ensure that at the point of a contract, there is a clear transparency between the policyholders as well as the Takaful operators as shareholders. So that line, no regulator will compromise that. And in the GCC, they believe that also some of the scholars, they believe that you cannot promise outrightly to deliver a surplus because you don't know what is going to happen. And the Takaful insurance system is all about getting away from this kind of uncertainty. Garar in any form should be avoided because there is a garar whereby you promise the policyholders that you will be making distribution. So what we normally recommend for the regulators to ensure is that the Takaful operators should not be making this kind of commitment, and that's why in certain jurisdictions they are not allowed to make this kind of declaration and promise, and that they build trust. But I think there is a challenge, or maybe there is some kind of lack of the proactiveness by the Takaful operators to really engage with the policyholders, to really engage with the industry, to be able to provide this required transparency that is needed. And that's where the issue of trust is always surfacing.
Thank you very much.
Okay. I think both Faisal and Professor Habib have raised their hands earlier, and I think you're... So let's get a microphone over there, because that table's going to keep us busy.
What about this side?
Ah, okay.
Thanks very much, Peter, for the very insightful presentation. I think I learned a lot. I'm Shafiq Jakura, from a Sharia scholar from South Africa.
Hi.
I just wanted to ask a question with regards to the ownership of the funds in the participants' fund. Would we say that the participants own those funds, or would we merely say that they have some rights to the fund? Because when you say that they own it, then issues of inheritance and other related issues like zakat and those sort of things come about. So just something around that, if you have any thoughts on that.
Yeah, Dr. Bello looks as though he would like to answer it, and I am inclined to say that my first reaction would be to ask a Sharia scholar.
I think the issue is, that's the key difference between a bilateral contract and a unilateral contract. The Takaful contribution is a unilateral contract and is based on the concept of tabarru, which is the donation. So when you donate something, you wholeheartedly give it back, and you don't expect anything in return. But however, the Takaful model, the way it works, there is an expectation that is being built in the event that what you donated is actually not exhausted, then there will be something that will be coming back to you. That is the right to ownership is limited to the amount of distribution that may be arising at the end of where there is availability of surplus to be distributed. But other than that ownership, you have no ownership, because when you donate, you don't expect anything to come back in return. So I think that's my clarification.
So maybe we should articulate it as saying that you have some rights to the fund. They are owned by different entities.
Well, the right from onset, the Takaful or the policyholders' funds is actually not owned. There is a clear segregation that is not owned by the Takaful operator. So it's owned by the contributors, those that contribute. And you have some Takaful models actually whereby the contributors, the claims are not limited only to the contributors of the fund, especially the cooperative model and pure mutual models as well. So such kind of situation, you will have any ownership, source of ownership is only limited to the fact that you own the funds, but you don't have any additional right to that REX fund. But we have seen in other jurisdictions whereby the funds are segregated into investment funds as well as the REX funds. So for the investment funds, they do have separate regulation to say that there are some amount of limited rights that is being extended to the investment fund. All right, because potentially, if the REX fund is not exhausted, the investment fund will have to be returned and be distributed among the members. But where you have a Waqaf model of Takaful, then you don't expect anything in return. No surplus, no any distribution or any even return. That whatever return that is generated from the investment fund is flowed back or distributed between either rolled back to the investment funds or topped up the REX fund of the Takaful policyholders. I hope that clarifies. Thank you.
Yeah,
Okay.
Peter, this relates to the issue about capital of the two funds. I think one of the key variables there would be the wakala fee, what rate wakala fee is charged. So for example, if the wakala fee is 20%, most likely there'll be always surplus in the risk fund, but if it's 40%, most likely it will be in deficit and there'll be cut going back and forth. So I'm just curious whether there are some regulatory insights in this, because I think Bahrain is probably one of the few jurisdictions where the regulators have some guidelines of what the wakala fee is, because they're aware that depending on the wakala fee, you will basically have problems with the risk fund card going back and forth frequently. So if it is at lower rate, then you will not have that problem. So, I mean, I think there should be a regulatory perspective on this to have stability in the risk fund, and also, of course, because there will be a tendency for the shareholders to have a very high wakala fee and then just give card so that they can extract the surplus from the premiums.
Yeah. Thank you, Prof. Habib. I think that what we do in our standards, we allow flexibility because we adopt principle-based approach in developing the standard. We allow the respective jurisdictions to be able to guide based on the size of the market, the maturity of the market, and to come up with some certain criteria with a threshold to the maximum amount that the Takaful operators should charge as a wakala fee. And that also has to do with the level of the management or operation of where we have, there is a Takaful activities that is involved, there is investment that is involved, there is claim management that is involved. Then in that case, it's left for the jurisdictions to be able to determine how much they charge. But I think generally the regulators were very, very responsive to what's the market fee for their benchmark, usually with maybe funds management fees for those that are doing in the capital market. If they are managing for investments, what's the rates normally that they charge for that? And then they come up with some guidelines to that. So there is no single answer as for the IFSB prudential standards. What we recommended is for the regulators to determine based on the jurisdictions, because some jurisdictions whereby the market is just emerging, putting high rates or allowing such kind of high exorbitant charges as wakala fee, and that will be an issue. So in addition to that, also some jurisdictions, they don't even have the wakala model. They normally have different other models. They can have musharaka model or mudaraba model or modified mudaraba models. They have various models for that.
Right, one more over there, and then I have a couple of major claims on the other side.
Sure.
And at least one at the back.
Yeah, thanks, Peter. You guys have got a global perspective on Takaful in terms of seeing good practice, bad practice, where the markets are thriving. Would you say Malaysia is probably the foremost country where Takaful is thriving? Because I saw a presentation 2-3 years ago where it was said in the presentation that the model there has worked really well to the point where surpluses are given back to policyholders, which they don't obviously get in the conventional space. And Takaful was now starting to overtake conventional insurance, and it was really, a very good thriving model. Is that right? And or is there any other good examples around the world where Takaful is really thriving well?
I think this is a fine occasion for ducking and weaving. I think Malaysia has certainly done well with Takaful, and it has managed to attract a significant proportion of non-Muslim policyholders. It has done so in a market that, by comparison with some of the others, has a fairly good insurance penetration, and which also, as I said very near the beginning, has a tradition of saving for the future through insurance, so that the life or family business is stronger in Malaysia than elsewhere. It has also promoted it in other ways. For example, it has been easier for a foreign insurer to establish in Malaysia by setting up a Takaful company than a conventional one, easier to get a license. So there's a number of reasons why they have got there. But yes, in terms of penetration of the market, they have done pretty well. Now, what I could not do, however, is give you a global comparison and attach reasons to that. Dr. Bello might be able to.
I know I will not be able to do that, but what I can share is that, not that I will not be able to do that, but I'm not mandated to disclose perhaps a comparative results of performance. But I think it's as a result of many factors. I think robust regulatory framework play a greater role, greater commitment by the Takaful operators to reach out and have more public sensitization programs and consumer education. This is very, very important. To have a level playing field among all the, between insurance as well as the Takaful operators as a framework is quite essential. The political will and the level of financial literacy and financial sensitization play a greater role as well. And the level of regulatory compliance and the supervisory aspect, because the capacity of the regulators, the ability of the regulators to be able to supervise effectively, that really play a greater role. But in jurisdictions whereby the regulators themselves lack the capacity to understand how the Takaful models work, that really stifles growth as well. But most importantly, the issue that I would like to highlight, based on the supervisory issues highlighted by Peter, is that there are a lot of ethical issues with the Takaful CEOs, for example. A Takaful CEO wants to operate like an insurance CEO. You are operating a different world. Whatever the insurance company take as a premium, they take it. That is a money gone by the policy subscribers. But in Takaful, it's not similar. So you have some kind of ethical lifestyle and issues that you see, the way that the Takaful operators, they want to compete with conventional insurance. You have a different business model, and it's quite difficult for you to. So in certain jurisdictions, this play a greater role in the success and the sustainability of the Takaful industry. Yes.
Thank you very much.
Okay, now, so I take the point, but a couple of gentlemen over here who've been waving at me for quite a while. Probably at the front and then over the back.
Peter, thank you very much for the very, exciting, presentation. My name is Jani Ibrahim. I'm from NASIMA, which is the National Chamber of Commerce in Nigeria. My own question is going to call on your experience, and perhaps maybe Dr. Bello may also want to jump in later. And that is to say that coming out of our own territory, Nigeria, and most of sub-Saharan Africa, we already have problems with conventional insurance. We have major problems with conventional insurance. And now my question is, how do you see the introduction of Takaful in these territories, so that it could be sustainable, and it could also be, acceptable. So that's why I'm saying that I'm calling on your experience, from all the territories and all the, the issues you've handled, to see if you could advise on this, please. Thank you.
I'm not sure I can say very much. What do you see as the major issues with conventional insurance?
Well, essentially most, in fact, governments have always tried to make them compulsory, for people to even adopt the minimum, which is like maybe the car insurance, for instance, is compulsory. You could be arrested if you don't have the minimum basic car insurance. We've been working on even health insurance, and that has been, in the last 6 years, it's been a very Herculean, exercise, to get people to subscribe, to even health insurance. So that's why I'm saying that maybe from your own experiences over time, you could help. And that's why I said that maybe Dr. Bello can also jump in on this. Thank you.
So I think maybe perhaps from our own assessment, because I mean we have 3 regulators, or I mean 4 regulators from Nigeria that are members of the IFSB: the Central Bank, the NICOM, the NDIC, as well as the Securities and Exchange Commission. That is, the insurance regulator is also member of the IFSB. What we have just discovered, I don't know, I think it's more of public education, market education, to drive the market penetration, because we thought our own understanding is that Anur Takaful, that is registered in Nigeria and that operated, actually is the first in the region, in the entire West Africa region, to declare a surplus of 200 million, which they did just about 2 months ago. So I think the declaration of distribution of 200 million surplus by a Takaful company that is just 5 years old is something that is very remarkable. And we believe the market can be driven through a constant engagement, market education, transparency by the operator, as well as the support by the regulator. So I foresee maybe when you are talking about the wider coverage, then you have to start thinking of leveraging on the insurtech and digitalization to be able to have a wider separate and coverage. That's what I can say for now.
I'm afraid the organizers have started waving at me. Do I have time for one more? Okay. I'm afraid it's going to be this gentleman here.
Okay, I'm aware of the time. Just very quick question. In every Takaful company, as in every Islamic financial institution, there is a Sharia board. My question is very simple. The Sharia board is usually paid for by the company itself. Don't you think there is a conflict of interest? And is there any solution? So it's like the FCA or the PRA is being paid by Barclays Bank and Lloyds Bank. So that's where the situation is. Thank you.
Okay. Interesting. Of course, to some extent, you are relying on the integrity of the scholars. Yeah. To some extent, you rely on the credibility of the scholars. Yeah. And, of course, the extent to which credibility impacts will depend, to some extent, what market you're in. Some places and some people are in a better position to say these are a credible set of scholars. This does, however, play into the debate in part about whether you need a national Sharia board. And look, I've been around places where somebody from a Takaful operator has said, well, my Sharia board won't let me do X, but the company down the road offers this policy all the time, and how do they get that past their Sharia board? And of course, it may just be that you're dealing with something that is on the edge, and that scholars of high integrity can get to different conclusions in different places. Could be the management's fault, they're presenting the question differently. But if you see this sort of divergence in practice going on, especially in a retail market, it may be one of the things that motivates the regulator to say, look, we're going to need to have a more standard practice, and this is the point where you begin to think about a national Sharia board. If you can, if your constitution allows you, and as I said, if you think you've got a real issue. One of the dangers in all of this is that you build a huge structure which makes it quite difficult for anybody to operate. And when I look around the world, yeah, I see some places in which Islamic finance is very well established, where issues of competition like this are serious. I also see some places that are just trying to get it off the ground. And they are thinking whether we can manage to get a Takaful company operating in this country. And perhaps a country without a strong tradition of Sharia scholarship anyway, Muslim minority perhaps. So I don't want to say everybody must have a. You build the infrastructure for Islamic finance gradually.
Yeah. just to add to you what you said, just said, Peter, is that in the Islamic financial institutions Sharia governance framework, there is a fit and proper criteria first, which the regulators should consider before appointing any member for Sharia board for any financial institutions, whether it's Takaful or banking or any mutual fund, Islamic mutual funds. In addition to that, fit and proper criteria, there are also safeguards that are being recommended by the regulators to ensure that the Sharia boards are independent. And then it's just like questioning, if you are questioning the independence of the Sharia board, it's like you build a masjid and maybe you are questioning whether if the imam will allow you to pray 2 rakat as against 4 rakat, something like that. So I mean...
Sorry, it's not the same case.
Okay.
So integrity and competence
yes, please.
Is a condition
for
even
appointment.
If you go to the FCA, if you are a member of any body, it is a must, but is not sufficient. So it doesn't mean because there is a independence for the FCA, that means the FCA officers, they lack integrity. So relying on integrity by itself, I know we may have that as for a short term, but what I'm advocating, what we want to see is an independent Sharia board, and this is maybe where the Islamic Chamber of Commerce can play a major role. That means we can have all the Sharia boards belonging to an external body because you are dealing with the public and with the public money. The FCA is there is to protect the public money and public interests. What we are looking at, we don't want to be, because we want something spiritual, something in compliance with our beliefs, belief system, we don't want to be cheated on that. So how we do that is independence, and this is like in the Islamic jurisprudence, Imam Ahmad says, if you see a scholar going to the palace of the ruler, is not a proper scholar. Why? Because there is an issue of independence. So the matter of independence, whether it's in judiciary or in controlling, is a Muslim invention. I do completely understand that when we want something to take off the ground, we may compromise. We may pay more money for the same product. We may do all of that. That's fine, absolutely fine. But how can we sitting here, how can we look forward, have a plan? And because here we have the Islamic Chamber of Commerce or the OIC, we can look for something that can get us to that level. Thank you.
Thank you very much, brother, for your contribution. I think it all depends on the jurisdiction. You cannot have one size fits all. As you rightly mentioned, we have different mazhabs, all right? And then different scholars' views and different composition of the scholars. And likewise, even for the establishment at a corporate level, in institutional level, to have a Sharia board, we have the centralized Sharia board model as highlighted by Peter, which is a national Sharia board, and then you have the institutional level. Now, at the institutional level, if a particular jurisdiction, for example, the UK now decided that the Sharia board for all this, for transparency and so on, will be appointed by maybe certain different body or association of Islamic banks. That's another model that can be adopted. So there is nothing wrong with having that. But in most cases, there are costs associated with the Sharia activities. There is also for the Sharia review and Sharia process that the Sharia scholars will have to undertake. Who is to bear that cost? Why is the source of that cost coming? That's number one. Number two, there is also an issue of reputational risk, whereby you are disclaiming, you are creating some assumption that the Sharia scholars cannot be trusted. So that's no, I mean, I'm just thinking aloud, but we take your views of another Sharia model, depends on the jurisdiction. But what we try to understand is that to make sure that the Sharia scholars are trusted, because these are scholars that they're supposed to have the highest level of ikhlas. So if they have the highest level of ikhlas, we don't expect the Sharia scholars to dance to the tune of the Takaful operators. That's the second point. The last point that I would like to make is that the regulators always serve as a goalkeeper. They do have at their own level to decide whether to accept what is being presented by the institutions or not. In most cases where, especially where they have the centralized Sharia board or the national Sharia board, they are the one to make a final decision and they have no attachment with the Sharia board at the institution or the financial institutions. So I think this is something that we may need to have a global perspective of it, and then to understand there is going to be an implication for whatever model that we do, but is an acceptable model where the association of maybe Islamic banks or maybe a different independent body that is coming up to set up the Sharia board that can be used by the financial institutions. So, I mean, it's all something, but the UK should have to have a discussion, a dialogue to come up with their own solution within the UK. And we can always be very happy to provide support where necessary.
Ibrahim is looking as though any further discussion will be drowned by the sound of rumbling stomachs. Is that right?
Yeah, and actually I hate to stand between them and lunch, so I'm just going to make myself very quick here. Thank you very much. I'm afraid we came to the end of this workshop together. I would like to thank every one of you for making the time to be here. And my particular thanks to IFSB as an organization, to Dr. Bello, to Mr. Peter, and all the team behind this great work to make this day that special as it is. As a part of our thanks, I just would like to invite the Secretary General of Al Barakah Forum for Islamic Economy, Sheikh Yusuf, to give them certificates. And our first speaker is Mr. Faisal Karbani. And Mr. Peter Casey. And I hope that you didn't miss the chance to scan the QR code to be able to download the material. And at the same time, you can register your name. We will send to your email your digital certificate for attending this workshop. Thank you very much again, and a delicious lunch is waiting for you. Thank you very much. Excuse me, we found some money on the floor, so please check your bucket. If you find that you are missing any sort of money, you can come to my colleague Hisham. He will guide you through. Thank you.